On this episode, we talk about active versus passive investing, NFTs, and Ben brought his charts. Welcome to episode 11 of Think Heart. Okay. Welcome to episode 11, Think Heart. I'm Scott Goodfellow. This is Ben Hart. We are Hart Investment Group. You know, Ben, I feel like I don't do a good enough job really promoting who we are, how to get in touch with us, stuff like that. We do have social media. We do have a big relaunch coming up, which we haven't done officially, so our platforms are going to change over the next few months. But I think right now, the best place for people to find us is LinkedIn, right? You can find us on LinkedIn at Hart Investment Group. Ben and I both have our own LinkedIn profiles as well. Definitely come and follow us there as well. Obviously at Ben Hart and Scott Goodfellow. I'll link all those things down below in the description too, so that you can click on those and give everybody a follow. The other thing I forgot to do too, we're a growing community here. You gotta like and subscribe, right? Like any good YouTuber.
Yes.
Right? I gotta promote the like and subscribes. Yes. Right? We really, we gotta get, our first milestone is we gotta get over 100. We're on episode 11, we should be there by now. Right? But I don't think we've really been pushing it. We've been focusing on delivering the content, right?
Yes, exactly, yeah.
So we're coming off a big episode last week of, we went heavy in the options. I watched it back.
Yeah,
what did you think of it? What did you think of it last week?
Yeah, look, I mean, when you go into you go through the interview and the whole presentation, and at the end, sometimes you're like, how did that go? How did it play out? The feedback's been pretty good.
Really good.
Lots of people have liked what it was said and the details and everything that Ryan went through. Feedback not only from the clients and other advisors that have watched it. Feedback from our compliance department even has been great, and compliance department from other places, if you can believe it.
Yeah, more or less, it's been good. Yeah. Hey, you know what? Like that was a heavy subject, and like you said, a lot of people loved it. It really showed the knowledge of Ryan, and and that's what we're trying to do here is like bring on those experts for people that want to know, that want to get more into those types of things, right? I watched it back. I thought it was pretty funny because I didn't have much to say. It was pretty advanced. But hey, we're not trying to fool anybody here, right? Like, you are the investment guy, right? I am here to help you build the brand, right? We're building a big brand here, right? We're not just changing the game. We're starting a new one. And I think with any good team, there needs to be, you're the steak and I'm the sizzle. You're Warren Buffett, I'm Charlie Munger. You're Ron McLean, I'm Don Cherry. You're Bert, I'm Ernie. Yeah. All the best duos, right? There's always one guy and the other, almost complete opposite. So let's not kid anybody. If somebody's looking for an investor or an advisor, right? They're coming to you for those questions. Not for me.
That's it.
Right?
Yep.
Exactly.
Yeah,
So when we have a guest like that on and the topics get heavy, I sit back, throw in a few jokes, right?
Yep.
Enjoy and learn myself, right?
Yeah, exactly.
It's awesome.
Exactly.
It's awesome.
I know.
That's why it works so well, and that's where we're going right to the top, bud, me and you.
You got it. Here we go. Listen, I had a buddy of mine ran into Ron McLean after a hockey game, and they're having a few drinks at the bar, and Ron just was crushing it on the dance floor. He loved to get out and dance out there, so we'll save some of those moves for you later.
I think, actually, now that I think about it, are you Ron McLean or am I Ron McLean? Are you Don Cherry?
I don't know. I think so.
I don't know.
I think so.
Regardless, well, you're definitely Bert and I'm definitely Ernie, I think. Same shape, and anyway, Ernie was funnier. Bert was a serious guy, right?
Yes, always getting mad.
Anyway, I digress. I guess we got to get into some business. People want to know about what's been going on this week, what's in the news.
Yep.
So, how do you want to start? What do you want to start with there, Mr. Master Investor?
Yeah, so maybe we can start with the passive versus active to start with, and then let's start with that, and then we can maybe delve into the NFTs and take a run at that. I know you've been reading a lot about that, and certainly an interesting subject.
Huge fan. Huge fan.
Yeah.
Huge fan.
Yeah.
Okay. Well, let's talk about that. I mentioned about changing the game. You've been changing the game. I think that's maybe a big conversation, right? I mean, active versus passive has existed for a long time, so I'm exaggerating.
Sure.
Right? Obviously, that's my rule here. I exaggerate things. So, but active versus passive, maybe you can talk a little bit about those, just kind of as an overview of those two different strategies.
Sure. Yeah. So the passive strategy, we'll start with, probably easier to describe. The passive strategy is where this indexing has come from, and Vanguard's kind of been the leader in this space, where they brought out these ETFs, which are exchange traded funds that track and replicate the index. So if you are looking to buy the S&P 500 and you just want to do what the S&P 500 does minus some fees, you buy an ETF. And so you had Vanguard really being the leader in this space, and really what's happened is they really have been sucking in a lot of capital. So passive just does the benchmark minus fees. So hypothetically, what we saw happen last year, if you own the S&P 500, you would have owned the SPY, probably something like that, which is the S&P 500. It tracks it. So when it went up at the start of the year, you participated. When it went down 40% in the year, you also participated on the downside. And the objective of that passive investor is to just replicate what the index is doing at any given point.
Gotcha.
So, I mean, this took and has had a lot of attention, because you've had a lot of famous people, put money towards this, and you've had, Tony Robbins talk about this passive investment style, and it's the best thing in the world, is to follow this passive investment style, where you buy a basket of ETFs that you never have to change, and as long as you assume that everything that's happened over the last 40 years is going to happen over the next 40 years, you're going to get the same kind of performance. So it's really a hands-off approach, where I'm not going to try to investigate anything to do with the market. I'm just going to put it into, we'll call the market, and we'll let it happen, whatever happens.
Right. So is that how most people invest these days, or?
So, the challenge is trying to find some of the Canadian information. The intel in the U.S. is much better, but if you look at fund flows, if you look at where money's coming into the market, it's 100% of fund flows is going passive.
Right.
Yeah. So if you look at capital flows, it's where the money, where that money's coming from is it's coming from the IRAs and the 401ks, which are similar to the RSPs, where they suck in all of the capital, all the new money that's coming into the market. It's all going into Vanguard or BlackRock, and they're the ones that are taking all of the new capital. So as you see additional fund flows, it goes in this passive investment. So, we're definitely in a bubble of passive investment. And, that's part of why we have this skew where you have Amazon, you got Google, you got Apple, you got all these companies that have gone up kind of in a straight line, where there's not a lot of thinking involved. It's just these ETFs. Every month money comes in. These billions of dollars that are being saved by individuals in the U.S., they're all going into these same passive strategies, which is jacking the prices up of the underlying holdings. Because, for example, when Tesla came into the index, when they were added to the S&P 500, every single ETF in the world that tracks the S&P 500 had to buy their shares. And so every month, as more money comes in, they have to buy their shares. So there's no thinking around, they don't make money, or they trade at 1,500 times earnings. It doesn't matter. It's irrelevant. A passive investor goes in and buys every single day that they have to map that ETF.
Right. I mean, that sounds reasonable, right? I mean, why wouldn't just everybody do that, right? It's an easy thing. Maybe seem less risky versus an active strategy, right? So how's that different than an active strategy?
Yeah, so obviously some people like to take that approach because it's easy and simple and they don't need to think about it. But what happens is you end up getting these massive skews and as valuations go up. You know, in 99, 2000 in Canada, you had Nortel and JDS making up something like 50% of the TSX. So what happens is the inverse of that. When those things start going down, you participate harder on the down than if you owned a balanced portfolio, a mix of different holdings. And we see it happen kind of everywhere in the world. And you know, in Finland, Nokia was 50% of their market. So if you own passive, you got crushed on the way back down. And right now, what we're seeing in the Nasdaq unravel a little bit. Is you're seeing it come down. It's down probably about 15% peak to trough right now, where you know the S&P, which is a bit more diversified, the S&P would own industrials, materials, financials. Nasdaq wouldn't have any exposure to that. So if you've had the benefit of going the upside, now you're getting hit really hard as things start to sell off.
Right.
Yeah.
So what's your approach then?
Yeah, so the active approach, and you know, I think that there's multiple ways of active, right? So I certainly will talk about my approach. Maybe I'll just blanket active first.
Yeah.
And so active people seem to think that mutual funds in general are active investment managers. Well, there are a lot of mutual fund managers that would be active investors, but the majority of them are not. The majority of them are benchmark huggers. So if you look at, I won't mention any of the names of those funds, not right now anyways, save that maybe for another day.
Yeah, that's for episode 50.
Yeah, exactly.
We're calling everybody out. Episode 50. You're going down.
Exactly. Most of them look like, if you looked at, we'll just say a Canadian equity fund at one of the big Canadian mutual fund houses, they're going to look like the index plus or minus a couple percent. So their comp is going to be based on how well they do, their compensation, how much they get paid is going to be based on how well they do against their benchmark. So, you know, if their benchmark is down 40% and then down 35%, they get paid better because they outperform their benchmark. Even though they lost 35%, they did 5% better. So then again, on the upside, if they outperform on the upside, they get their bonuses. But, you know, so they're not willing really to be an active manager. They fall somewhere on the line, looking to maybe squeak out a little percent here or there of returns. And typically, if you're owning that kind of investment strategy, you're going to pay 2.5% for it. And so, you know, if you're comparing that to an ETF, that's probably not, you know, your ETF's probably a better route for you. But then if you wanted truly active, which is what we do, you know, there's some thought around what's happening in the world. So from what we do is we look at where are we in the market cycle? Where do we expect this cycle to go and head? And then how do we position the portfolio to ensure that we benefit from that? And so that is also in good markets and in bad markets. So obviously last year was a very bad market. So when markets sold off hard, the portfolios didn't feel it. And so as markets rally, you're in a position to benefit because the portfolio starts moving higher quite a bit sooner because you have a significantly less drawdown.
Right.
And so, you know, that means you have to be active and pay attention to the daily moves in the market and the daily moves in the economy.
So it seems like it'd be more of a challenge for the advisor to be an active investor, right?
Yeah.
Like take an active approach versus a passive approach, right? Because if you take a passive approach, you're basically go ahead.
Yeah. So I don't think a traditional investment advisor can be active anymore, because a traditional investment advisor, they need to pick up the phone and call their clients every time they do a transaction or a trade.
Right.
If you got 150 clients, and you decide you're going to sell your stocks in one company and buy it in another company, you're going to get 150 calls. You're going to get 150 different fill prices. You're going to get a little bit of maybe some better performance for some, worse performance for others. So I don't think you can adjust to the current environment with that traditional style.
Right. Yeah, that makes a lot of sense, right? If you had to call everybody every time you made a trade, I mean, it wouldn't be possible. And I think most advisors, and so as far as, so how many advisors have are portfolio managers that have discretionary clients?
Yeah, so I'd say there's quite a few advisors that carry the title, or they call themselves portfolio managers. But I'd say there's fairly few that actually run their portfolios from an active discretionary management style. A lot of them will track something. They'll track whatever they're told to track at the firm they're at, and then they'll adjust the portfolios based on that. And a lot of others too, again, will just have the title to have the title, but not actually run discretionary portfolios. So I'd say it's a fairly small number based on my experience.
Right. So is there more risk with one or the other, do you find, or no?
Yeah, so I mean, I think everyone views risk will run one way, right? Like they say, you're taking more risk by being active, or you're taking more risk by being passive. So I would say that my view is that you're taking more risk by doing nothing,
Yeah.
where many others' view would be you're taking risk by doing something. So the classic example of this is Bitcoin, and I know we've talked about it multiple times. I know we'll touch on it more when we get into my charts, so that'll be exciting.
Yeah.
But that's a classic example where I look at, I look at it and I go, what am I taking a risk by putting this in portfolios, or is the risk that I'm not going to put it into portfolios?
Right.
And so, I would look at it from that perspective. And so, I think everything is about managing risk. And so I spend as much time on managing risk and managing downside as I do on managing upside, where people look at things that maybe appear new and think that it's risky. I think it's more risky sometimes to not pay attention to what's coming and what's ahead. And, as we've talked multiple times, this business that spends so much time on looking backwards. Well, this worked. This is what worked last time. This is what worked yesterday.
Right.
Instead of, what's working ahead of us. And so I think there's a bigger risk at not thinking about what's working ahead of us,
Right.
than doing nothing.
Just last question before we move on about that is how do you think people should know which one is the right one for them? Right? Like, I mean, everybody has a different style that they're comfortable with.
Sure.
Right?
Yeah.
What, in your experience, what do you think? Is there a type of person or stage in their life, perhaps? Right? What do you think would be the best?
Yeah, so that's a really great question, and really comes down to kind of what kind of a screening tool should you use to see what's right for people. And so that's a great question. I don't have a simple answer for you. What I found from dealing with the clients that I've dealt with over the years, it's completely what is the right fit for you, and what that fit tends to be a lot more soft variables than it is hard variables, right? Like when you talk and meet with somebody, you have to connect around what you're doing, what your style's like, what your comfort is, and really you got to find out what that fit is. And so, as I've dealt with clients that weren't the right fit for me, we've gone our separate ways, either from their choice or from my choice. And now when I meet with clients, that's kind of is, look, I can show you what I do. I can prove to you, here's what I've done. Here's how I perform for clients. Here's my fees. Here's the costs and all of that. But at the end of the day, if we don't like each other, we don't get along with each other, the relationship's not going to work.
Right.
So ultimately, I think it really is what's the trust you have in your team and your advisor, what's your comfort in what they're doing and what they're thinking about is really the priority of how you get there. How do you screen for the right kind of person to fit with you? That's a tough question.
Gotcha.
Yeah.
Well, yeah, definitely something to cover more as well. I think, especially in markets like this. A market like this, it certainly is a benefit to being active, right? You can react on a day-to-day basis. I definitely see that as an advantage.
Yeah, certainly. So I met with a prospect a couple of weeks ago, and that was one of their questions. Like, what did you do? Like, what have you done in the last 3 months in the portfolios? Because the advisor that they're with now has done nothing.
Yeah.
Like zero.
That's a great opportunity to plug exactly what we do. We just started recently. A lot of people would ask, oh, what are you doing? And they will, rather than meeting with everybody all the time, right? Then we actually started doing a live stream every Friday afternoon where Ben actually goes over the trades that he's made, not individually, right, but as an overall portfolio, and goes over it, and it's for clients only, right? So we don't have to worry about it.
Yep.
And whoever wants to tune in, tunes in. We record it, we send it to the client base only, and then they know what Ben's done in the last week. And he also mentions on there, he talks about any current events, anything that he's watching in the market, and what the plans are for the next week as well, which I think is a game changer. I don't think there's anybody doing that. So I think that helps people stay informed, kind of like what you're saying.
Yeah, exactly.
Yeah,
exactly. So that's what we found is you meet with the client after 6 months or a year, and you don't talk through the 100 trades that you made last year.
Yeah.
They just see a static portfolio in front of them. So it's been really has been good. Clients have loved it.
Yeah, definitely.
Yeah.
Like keeps them involved, right? Nothing like parking your money somewhere you don't know what's going on with it, right? So I think it's been a breath of fresh air for people for sure. Okay. I've been wanting to talk about this for weeks, right? But, there's like anything new, you have to really start to understand it. And I would say we're still at the very tippity top of understanding. It's kind of like where we were with Bitcoin like a year ago, let's say. So we're going to introduce this in the podcast for the first time ever, NFTs. Okay, some of you may have heard of them before. But most people haven't. So they're non-fungible tokens. So this is a new way. It's basically fractional investing. Did I say that right, Ben? I think there's a lot of different ways that you can get involved with NFTs, right?
Yeah.
But for the most part, it's fractional investing and smart contracts.
Yeah.
Right. What did I miss to the we can go on and explain more, but what other things would you mention that it is?
Yeah, so I think that's right. I think that's a good way to describe it. The other way I would think to kind of add that is it's really fractional ownership of anything.
Yeah.
Like fractional ownership of any asset
That's
in the
a good
world.
point. Yeah. Yeah, I mean, these things people have really embraced this, especially people with big communities, right? So you see big YouTubers, really starting to monetize everything that they're doing and selling pieces of their businesses by doing this, right? And I think a good example would be like art. It's big in the art world right now. Is probably where it's taking off the most, and probably collectible items as well.
Yeah.
Right? So think of it like this, where an artist would typically, sell their painting, and let's say they're new in their career and they sold it for $1,000, right? And they would hand it over and they would get their $1,000 and that would be it. Right? Now, what you can do is, and this is for both hard assets and digital assets as well, you can create a smart contract. Let's say you sell that for $1,000, and then that person turns around and sells it for $10,000. Well, within the smart contract, that artist can write into that contract that they get royalties on that painting forever. So that grows as their popularity grows, the value of that asset grows as well, right? And they continue to get paid on it. Royalties, just kind of like a movie star that would take royalties on or a sitcom star like Seinfeld will get paid for Seinfeld for the rest of his life, right? Every time somebody watches it.
Sure.
So every time there's a trade made on that asset, that artist gets paid, which I think is going to be a game changer for especially artists, right? I'm sure there's a million other ways that it's really going to benefit, but that's just one way, right? I know you have a couple other ways. Why don't you jump in here, Ben?
No, that's great. That's a good description.
Yeah.
And I think that it could, I think that where the crossover happens at some point is it comes into the financial world.
Yeah.
We've seen some of it already come over into the sport world, right? Or you had one of the NBA players there tokenize his contract.
Yeah.
You've seen it in kind of early stages where you've had one of the hotels in Tahoe, I believe, tokenize their property. So I think where the huge crossover becomes is when the financial world comes around to this and they say, instead of going to X investment bank to raise capital, and it's going to cost me 6 to 10% to raise that capital. It's going to be labor intensive. There's going to be errors. There's going to be problems. What about if I did it through a smart contract where I can track it, the trackability, the recurring revenue, as you say? I think that's where the huge kind of crossover happens. And you've had some companies start to do that now, and you've had, I think we mentioned at one point, we mentioned T0 on the podcast. You've had some of these companies starting to think about how this works into the real world. But NFTs definitely seem to be the rage right now, and you've had we've seen it on Twitter, right? We've seen some of the famous Twitterites, including the CEO Dorsey, sell his first tweet for $2 million.
Yeah.
So tokenized his tweet and he sold it for $2 million. Yeah.
Yeah. So I already want to handle some of the objections that come up when it comes to this. One specifically that I've heard so many times already when I try to explain this, and I've kind of tested the waters when I just throw it out to people that that I run into just in conversation to see what their initial feedback is. I did the exact same thing with crypto and Bitcoin, right? And then because then you get the initial objections, right? So the first objection is, oh well, why would anybody ever pay for like a digital asset like a tweet or like a piece of art, like a digital piece of art, right? When somebody can just copy and paste it or save it digitally or whatever, right? Well, I think there's a couple arguments to that. A couple rebuttals is, I mean, there's tons of forgeries. Like how many famous paintings like the Mona Lisa, how many forgeries, or not even forgeries, prints of those types of things, or famous photographs or whatnot, right? There's tons of prints. So, but if you own the original, right? Then that's what really retains the value, right? So I think people get stuck again with we saw the same thing with Bitcoin when people was like, oh, well, it's not like gold. It's actually exactly like gold, right? It has no real value, right? As far as that's concerned. So I think it's if you can wrap your head around just the world changing how it works, just as I think last week or a couple weeks ago I compared it to the internet, and it just becomes more and more clear that that's exactly what's happening, right? Is that with finance, this is well, not just with finance, with the whole blockchain. I think this is what's the world is turning to now, and this is just another piece of how, because where do the smart contracts live? Do you know? Do you know where do you have
the block? On
the blockchain, right? So it's all coming together very similar to the way that the internet did, right? So that being said, you're going to see all these fingers branch off, just again like the internet did. Like Ask Jeeves didn't make it when Google did, right? So you're going to get a lot of people to point when some of these things fail and say, see, I told you that's not going to work like that, right? But that's not the point. We're building a new economy here, like a new social economy basically from these tools.
Sure.
Sorry, I went on a bit of a rant there. I got a little too excited.
No, look, that's fine. That's good, and I agree. I mean, I think that I think we're probably like Bitcoin 2017, 2018. Like, I think we are getting a little bubbly on the NFTs.
Oh yeah, for sure.
And you're right. So I do think we cycle. But certainly it's an important thing to think about, and I think it's going to be integral in the future.
Yeah, I think it's going to mirror. I think it's going to mirror the way the internet worked too, right? I mean, we had the huge bubble burst in 2001. I don't think we've hit the 2001 yet for crypto and blockchain and NFTs and stuff like that. Yeah. Right? There's still going to be a big sell-off.
Yeah. Sure.
Anyway, do you have anything more to say about that? I got all in the zone there. I felt like Will Ferrell on Old School when he had to in the debate when he just went in the zone. Frank the Tank. What did I just say?
No, look, I think that's a good introduction. I think there's a ton of learning still to be had there. There's a lot of the companies that are involved in it are still pretty in the early phases. I think that there's still lots of money being thrown at it and chased around, and you see these the things being sold at crazy levels, and you hear these stories about cab drivers in New York City being invested in these different kind of NFTs. So a lot of those kind of side stories are kind of telling you that it's bubbly, and some of these valuations are crazy. But I think very important to think about it to further understand it. I mean, this tokenization of assets is very abstract still for people to understand. So hopefully we can continue to evolve to understand the block and continue to explain that. Maybe we could get an expert on to talk really about kind of that blockchain and what it looks like and feels like, and maybe do a better job of contextualizing it.
Yeah. You know what we could even do is we could put up a slide of an NFT the next time, and like, for example, that NFT just sold for like $68 million, right? A digital art piece of art just sold for $68 million. We can bring that up and kind of do like a case study on that. Be easy enough to do ourselves.
Sure.
But yeah, for sure.
Yeah.
Well, and I think the other thing to say too is that, as advisors, we have no way to invest in this. It's not really at this stage. It's an alternative investment, right?
Yeah,
but
exactly.
You and I have been talking about this for probably a year, right? With T0, like we saw this coming a year ago. Yeah. Right? So So I think there will be, like you said, I think there'll be a way. I think it'll integrate with regular finance. It's probably a year, at least a year away, maybe 2 or 3.
Yeah, you got to think that some of these companies like Galaxy Digital and some of those forward-thinking cryptologists are thinking about how do we use this now? How do we make it work within our business? And so you got a guy like Mike Novogratz, and I keep referring to him because he's kind of that crossover guy, right? He comes from the finance world and then got really interested in Bitcoin. So he's got the kind of the knowledge and the thinking about how it works in both worlds, like how it works in the crypto world, but also in finance. So you got to think these companies are thinking about that.
Yeah. Hey, if we talk any more about crypto and Bitcoin, we're gonna have to switch the name of this podcast to Real Vision. Hey?
Yeah, exactly.
You'll be Raul and I'll be I don't know.
Ash Bennington.
Yeah, Ash. I like that name actually. I don't know anything about the guy, but I like his name. Yeah, it's hard to ignore. It's a thing. Like if we were doing a podcast in the early '90s, we'd be talking about the internet and internet stats every single podcast, right? It's the same thing.
Yeah.
I gotta stop using that example, but it's a good one.
For sure. So we ready to move on? Drive on from it?
I think we should go right. Do you think we should take a break and go into the phase transition, or do you think, like we're talking about Bitcoin, you just want to get right into your charts?
Yeah, I think so. I mean, it's just a little chat before I get that. It was Hedgeye Summit this week, which is I've talked about Hedgeye, work and follow their research and information. So we had I think we had 10 hours of presentations this week that I listened to and watched. Some super interesting stuff. One thing that I picked up that was a surprise that I hadn't thought about within the Bitcoin complex as a negative, which I'll mention at the end, was kind of the first thing I thought, well, that's something I hadn't thought about within one of the risks. So it's always good to, have your view, but it's also important to realize there's important variables that you need to think about at all times. So I'll bring that back in at the end. But super interesting presentations, lots of great people. It's really more talk on macro. There's a couple of hedge fund managers that gave some interesting, great trade ideas, which I can comment on another day. But it's almost the end of March, almost the end of the first quarter, so we've got to start to get to think about wrapping up that first quarter and start to write some research around that. But yeah, let's jump into the charts here. I think this is a great opportunity to talk about this. Just let me get my screens up here.
And this is a groundbreaking moment for the Think It Heart podcast.
Yes.
Well, I just thought of one thing, is that this is also an audio version on Spotify. A little plug, not a big deal.
Yes.
Yes. Keep the change. And so you're going to have to describe it for audio too. So over-describe the chart, if you don't mind. Just keeping that in mind.
Okay. Yeah, that's a good idea.
Yeah.
So we'll get this in here. See, just trying to get it up, working on.
While you're working on that, I'll fill the void with
please.
a couple more comparisons. You're like Wayne Gretzky, and I'm like Fedoruk, right? The fourth liner they put on his line just to beat everybody up if they mess with him.
Yes.
You know what I mean?
Yes. Yes.
You're like you're like the ham. I'm like the burger. In hamburger,
Exactly.
All right, perfect amount of fill.
Let me know. Can you see it?
Perfect amount of fill.
So can you see it? Are you good?
I can see it. The people listening cannot see it. What's this one called?
Cannot see it. So that's a good one. So listen, we've had lots of questions around, is it a currency? What kind of asset is it? What does it look like? And so this is a great report put out by Deutsche Bank, March 15th of this year. So they came out with a report. Very interesting. Obviously, everyone's got their own opinion of it. I have mixed views. I'm not saying it's a currency yet. I actually do think it coexists along with many other currencies for a very long time. But this chart says total value of currency in circulation in U.S. dollars in billions. So there's a picture of the currency that's the most used in U.S. dollars out to the right-hand side. And so you got the U.S. dollar, of course, is number one. You got the euro as number two. And then the third total value of currency in circulation in U.S. dollars is Bitcoin. Followed after that is Japanese yen, Indian rupee, and so on and so forth. So, the thing that I think is the most interesting about this slide is that you're starting to get some of the big banks talk about Bitcoin as a currency, which a year ago, you'd never have had that. Even today, I was surprised to see this. Mark Yusko had posted this, and so I thought this was pretty interesting. Any questions on that, Scott, before we jump on to the next one?
No, you're going to get us banned from the bank, though, by using that, using that slide.
Deutsche Bank? No, it's disclaimered. We're good.
Oh, okay. We're good. Okay. We're good.
Yeah.
No, that's it's astonishing.
Okay.
The thing that's astonishing is looking at the growth. Like it had like Bitcoin 2017 or whatever, and then
right.
Just moving up is crazy in such a short period of time. The amount of growth.
Yes, exactly. Yeah.
Moving on.
The other thing, moving on. Let's keep going into the chart deck. So this is another one. Actually, I didn't disclaimer this one, but we'll make sure we get them in here. This is Citigroup. Citigroup put out a Bitcoin paper that is, I think, 115 pages. So a nice light read. But this has been something that Raul's talked about a couple of times, right? Where he talks about the number of addresses that are holding Bitcoins. And so as people thought kind of early on, I think there was the general thinking that it was controlled and concentrated by only a few. And until you got to a certain level, you couldn't have an actual price appreciation until you reached that level. And so, there earlier this year, you got to the point where Ethereum started to have 1,000 addresses for every of ownership of the coins. Obviously, Bitcoin continues to grow as we look at the chart there on the left. And then the other reason that it continued to think about the retail versus institutional ownership right now, this is one of the things that I think has kept me with the holding longer than I would have typically, right? Because the holding's gone up 400%. It's not often you get something that goes up 400%. So, but when we look at this, there's still the majority of Bitcoin is still held with retail, but you see the institutions starting to come in now. So you got North America as that first circle, where 30% of it is now institutional. If we'd looked at this slide even a year ago, that would be a fraction of that. But now 30% of the ownership of Bitcoin is institutional North America. And then we look at Europe. So similar type of mix. You get 63% retail, 30% institutional with a 7% unknown. And then we look at some of the other countries, Latin America, Middle East, North Africa, and Asia Pacific. So they got similar kinds of breakdowns. So I think when you look at the narrative, right, you get that kind of view that there's all this money is being used and held offshore by people doing illegal things and transacting in legal ways. But when you look at actually who owns it, who trades in it, it's very heavily weighted to the developed market. And I think if we didn't mention on the previous presentation about Bitcoin, 30% of all illegal transactions actually happen in physical currency versus somewhere closer to 10% of the transactions in Bitcoin are illegal. So that kind of dissuades some of those myths. So any questions on this presentation here?
Not really any questions. I think it's just I think charts really do the job of painting the picture. I mean, of where we're at with this thing. The thing that keeps blowing me away is the speed of adoption that the world is having now. Like, we're not having these conversations a year ago, right? Like, just not. Yeah. Right, and it's like the world has decided this is the way we're going, and now it's here. It's crazy.
Yeah, it's moving fast. It's certainly moving fast still.
Keep her going.
So this is let's go. We got a couple more here. So this is Hedge Eye's, some of Hedge Eye's research. So they were kind of early on they're really the first adopters that I know anyways that have back tested how Bitcoin does in different economic cycles. And so the one amazing thing about what Hedge Eye does is that they spend so much time studying the macro on a daily basis. And really what they've done, if they've gone back and they've looked at how both Ethereum and Bitcoin have done depending on the current part of the cycle. And so why is this important? Well, this is important when I think about my macro backdrop. So I look at where I think we are in the different markets. And so presently right now we'd fall into that quad 2 where we have US growth accelerating and inflation accelerating. Canada would be in quad 2 as well. And so obviously Bitcoin does well in that part of the cycle. It does well in quad 1, which is growth accelerating and inflation decelerating. We haven't had that set up in a while. And quad 3, which we had last year at one point, which is growth decelerating and inflation accelerating. So it's typically the best time for gold, and in turn it's also the best time for Bitcoin. But the quad 4, which is where it performs the worst, which is where most every other asset class, with the exception of treasuries, US dollar, and gold, tends to do well in quad 4. But it's an interesting thing to think about because I expect we get into quad 4 at some point this year. So as I think about positioning, I can have a long-term bullish view on something, but also have to think about how it's going to play out over the shorter term as well.
Interesting. And we're going to talk about the phase transitions, right, after this?
Yep.
Okay, cool.
Yep. Yeah.
All right.
And so I guess the last one here to have a quick look at would be how they compare to the different asset classes. So I would say that it's important to think about what's the correlation to Bitcoin to everything else. And so this is some really interesting stuff to look at and pay attention to as I think about how these different assets play off of each other.
Right. Maybe just mention a couple of those just for the listeners. Maybe mention a couple, like how it performs against some of these.
Sure. So on a 3-month basis, Bitcoin presently has an inverse correlation of 0.56 to the US dollar, and would have a positive correlation to, we'll say, 10-year TIPS, which is inflation adjusted bonds, 10-year bonds. On a shorter term period to look at, you can look at like the 1 month, for example. Tends to be interesting to look at. Of course, you have some positive correlations to some of the other currencies. So like Ethereum to Bitcoin would be a 0.81. Litecoin would be 0.76. So you'd have pretty high correlations to that. But then inverse correlations to some of the other things like volatility, a kind of a neutral correlation to gold, which is interesting because there's a lot of gold blogs that say, the reason gold's not where it is today is because Bitcoin is stealing all the attention. Well, that's not necessarily the case, or at least not necessarily reflective in the numbers.
Interesting. Love the charts. Love the charts, man.
Love the charts.
It's going to make a regular appearance in the Think It Heart podcast. So.
Yeah. Awesome.
Cool.
Awesome.
What else? Do you have anything else to say about Bitcoin here?
Yeah, so the last one. So I listened to Stephanie Pomboy. She's really interesting economist, forecasters, and thinking about valuations. She talks a lot about valuations in the world. There's one of the few people out there still that thinks that valuations matter. And so, she had a great presentation with Keith McCullough. And they talked about where she thought markets could go, and I won't give out my view and what she said there, but the one thing that was really interesting is she talked about what's happening with regards to the rating agencies. So as you see Square and PayPal and MicroStrategy and Tesla invest in Bitcoin, you've had the rating agencies like Moody's and S&P. They've decided that they're putting those companies under review. So they actually are, which I think is very interesting, something that I hadn't thought about. And they said, they still have a ruling out how they're going to recognize that capital on their balance sheet. And by moving cash, which is obviously perfect when the rating agencies are looking, right? That's the highest quality asset you can have on the balance sheet. So presently, right now, the accounting is you can record it the same way as an asset on the balance sheet, but Moody's and S&P and all the other rating agencies for that matter, right now have presently put that under review, and so it's something to pay attention to. I think that you would have a massive uprising if they did do that. By the Bitcoin community, the libertarians, like you could really get a huge revolt. But it's certainly something to pay attention to.
Interesting. Yeah, definitely. And you learned a lot this week, eh? That conference.
Always learning.
Hey, you're just a new man. We do have the Real Vision conference next week. Is it next week?
Yes, crypto conference next week.
Are you going to let me go to that one? You going to let me partake?
Yes.
Hey, coming over. I'll bring the popcorn. Hey.
Yeah.
Well, maybe.
Lots of.
I'll bring my Bitcoin foam finger.
I thought you were getting a hat.
I know. I don't know what happened to it. It hasn't showed up yet.
Did you pay in Bitcoin?
I didn't pay in Bitcoin. Maybe that's the problem. They didn't recognize it as currency. So, it's my cryptocurrency joke of the day. All right. Okay, you did touch on a little bit there the phase transitions, maybe potentially going into quad 4. Maybe just talk a little bit, do a very brief overview of what the phases are, and then talk about where you think we're going with that.
Yeah, so I think we're presently still in that setup where we're in that quad 2 setup, which is growth, or growth is accelerating, and inflation is accelerating as well. So so that's the present setup we are today. And so we've had really in the last couple of weeks kind of those first signals that maybe we're starting to get to the latter part of that. So when we first went into this about 6 months ago, you had China, India, South Korea. You had these countries kind of leading the way into that. And so they had that first initial bump and a huge acceleration. And that lasted up until about 3 weeks ago, I think, when there was a signal that we were starting to change, and those markets were starting to slow down. And so we had that happen. We had tech signal. We're starting to get into a place that maybe start to pay attention, take some profits off the table on that. So we're starting to see some early signals that maybe we're getting to, if you broke out the quad 2 into 3 sections, we're probably into the back third of this kind of growth accelerating and inflation accelerating. Today we saw that kind of first breakdown too in those inflation trades. So oil sold off. We had some of the other commodities sell off as well, and you had tech get cranked today as well, down with the QQQ down 3%. And at the same time, we've had the U.S. 10-year explode over the past couple of weeks. So the U.S. 10-year, you got to kind of 173, 174. My present view is we could kind of get into that 170 range. Hedgehogs got a kind of higher level of number, but you've had a lot of things start to signal that maybe we're getting late in this part. And so I still think there's opportunity. I still think there's money to be made, but we're starting to get some warning signals. And so as we start to think about the back half of this year, my expectation is we do get into that quad 4, which is slowing growth and slowing inflation. And so the one thing that I think if we watch, and I watch a lot of research from the banks and the other institutional houses, and they look at, we're on a straight line trajectory up and nothing can go wrong. I think that the challenge that the people have, and the thing that I've had to learn over the years too, is that, the likelihood is we're going to have growth and inflation this year. But what's the direction of that growth and inflation? So what's the rate of change of that growth and inflation? So, if we come off and we have a 5% print in GDP, when we probably got about 10% in Q2 this year of GDP growth in the U.S., what's the next quarter going to look like? Well, it's going to be less than that. So it's going to be less than that dramatically. It's still going to be a good number, maybe 4 or 5% GDP growth. But if you go from 10 to 4 or 5, the rate of change of that number is pretty dramatic, and the markets don't like that. And so, I used to look at an absolute number too and think, well, if we go from 10 to 5, that's fine. GDP is still growing, inflation's still growing. The market should be fine with that. But what you found, and what I found from following the data and listening to Keith and his team as they've back tested all this research, the markets actually don't like that. If the direction is changing, you need to change with that. On the other side of it, I think we start to accelerate again. But those kind of that middle of the year to maybe early fourth quarter, I think we get slowing numbers that could be quite dramatic if we stay with the existing positions that we have.
So how, when you often refer to these quads, right?
Yeah. Yep.
And you've been following them for a long time. How accurate is it? Like, do you find is it spot on every time? Like exactly what they've predicted that usually happens?
Yeah, so they've been very accurate. As for their quad 4 calls, they've been super accurate. So their actual calls on the that particular phase of the cycle, they've been the best that I've seen over my 20 years. So the challenge is it's not like you get a bing in your inbox and it says we're transitioning today.
Yeah.
Right? It's not like, here you go, here's the lottery ticket.
Well, it's here in quad 4. Yeah. It's quad 4 day.
Yeah. Exactly. Sell everything and buy everything else.
I put in a vacation request for that day, by the way. It's quad 4 day. I won't be at work that day, so just let you know.
Exactly. So they've been good, but the challenge and where my value add is that you actually have to manage that. You have to manage through that because it's not a signal. Like there's no signal at the top, there's no signal at the bottom. You have to think and pay attention to it, and the data comes in every day. So you have to look at it every day. So sometimes, kind of further to, I've had a couple of client questions where they're like, you bought Apple at 129 and then you sold it at 129 and a half. That doesn't make a lot of sense. Well, it's that 120 now. So you get that signal to buy it. You look at it. It seems to be working, but then you get a new data point, and the new data point says this isn't going to work anymore.
Yeah.
So you need to adapt to it.
Yep. So if this has caught some people's attention, right, and you've mentioned it a few times as far as the quads are concerned in this type of strategy, where do people, why don't you give them a plug since you refer to it all the time? Where can people kind of look into this more?
Yeah, so hedgeye.com would be the place to look at some of the research. They do have trials.
Yeah.
You can go in and look at, they got 30-day trials. You can try their daily macro show where they give an update on what they're doing.
Yeah.
So that'd be the best place. Keith McCullough and Darius Dale are on Twitter as well.
Yeah.
And they put out a lot of interesting stuff there too.
Canadians, too.
Yeah.
Living in
Keith
the
McCullough's
U.S.
Thunder Bay, yep.
Yeah. Where did Keith play hockey? He had like a
played
D1
so
scholarship.
he went to Yale. He went to Yale.
Play hockey there?
Yeah.
I think so, didn't he?
He played hockey at Yale. Yeah.
Play hockey at Yale.
Yep.
I gotta trust him. Okay. Want to wrap her up?
I think so. I think we're getting to the end. I'm just seeing if there's anything else that I hit on there. Nope.
That's
good. I think that's it. Yeah. So I think that we didn't talk much about yields today, but I think that's the big trigger, the big thing to pay attention to. So
next time,
you need to follow it.
Do we have something lined up for next week? Do we have a special guest lined up for next week? Is that a done deal?
I'd say it's 90% of the way there. Yeah. If it's not, they're definitely coming.
All right. Well, let's say who it is anyway, or what it's about at least.
Yeah, so it's Tom Savage. So he's an investment portfolio manager with Picton Mahoney, and they run a merger arbitrage strategy, and they also are an expert in SPACs. So they're going to talk about merger arb and SPACs and what they mean and what they do.
SPACs are hot, Ben. SPACs are super hot. We need this guy on to talk about the SPACs.
Yes, so that's going to be great.
The hot SPACs.
And merger arb. So
merger arb and hot SPACs. Bring it on.
Yeah, so we had Ryan last week. I mean, this is an institutional strategy that Ryan talked about with the options. And merger arb, again, like CPP and OMERS, they'd have their own internal managers that run these exact strategies. So this is going to be an interesting one as well.
Awesome. Can't wait.
Yeah.
All right, episode 11 in the books. See you next week. Think at Heart Investment Group. Talk to you next week.
Bye.